Gen Z and millennials are taking over investing. What can you learn? They're playing the game differently. Here's how you can too. It seems like every time we turn around, there's a headline about Gen Z or millennials doing something better than previous generations, and it can be frustrating, especially if you're an older investor watching headlines like this one from CNBC that reads, "Nearly half of Gen Z and millennial investors say they will not retire when they retire." But before you get too jealous, maybe there's something you can learn from these younger investors. When you dig into what's driving these headlines, you find a lot more nuance and some valuable lessons for investors of all ages. Let's start by looking at the data and unpacking what it means. Millennials are defined as people born between 1981 and 1996, while Gen Z encompasses those born after 1997. And both groups have shown a remarkable level of confidence in their ability to manage money. According to a survey by Bank of America, 69% of millennials and 74% of Gen Z said they felt confident or very confident in their ability to manage their finances, compared with just 38% of baby boomers and 53% of those in the silent generation. That's a stark contrast. So what's behind that confidence? Well, these generations grew up with the internet and smartphones, which made managing personal finances easier. In addition, many of them have seen firsthand the mistakes their parents made, like overextending themselves with mortgages or failing to save for retirement. This has driven a desire to do things differently. And when it comes to investing specifically, younger investors are turning away from traditional financial advice and taking matters into their own hands. A study by Edero found that 43% of Gen Z and 52% of millennials said they were interested in learning about investing through social media influencers, while only 23% of baby boomers said the same. But there is another even bigger trend among these younger generations that might make older investors' heads spin: going all in on crypto. Younger investors are putting a larger percentage of their portfolio into cryptocurrency than older investors. The numbers vary depending on the source, but a survey by Crypto.com found that 30% of Gen Z and 22% of millennials hold between 11 and 50% of their portfolios in crypto, compared with just 4% of baby boomers. So why are younger investors taking such a big risk? Well, for starters, crypto is a relatively new asset class, and younger investors have more time to ride out any short-term volatility. Plus, they tend to be more comfortable with taking risks, because they don't have as much to lose. Finally, crypto is seen as a way to potentially make a lot of money very quickly, which is appealing to a generation that has grown up with the internet and instant gratification. So what can older investors learn from these younger folks? Well, first, it's important to recognize that every generation has its strengths and weaknesses when it comes to investing. Older investors tend to have more experience and know how to navigate market ups and downs. However, they may also be set in their ways and resistant to new ideas. Younger investors may be more open to new ideas and comfortable with new technologies, but they may not have the same level of experience. The key is to recognize these differences and learn from each other. One thing older investors can teach younger ones is patience and the importance of long-term thinking. It is easy to get caught up in the hype of investing and try to make a quick buck. But the reality is that successful investing is a long-term game. It takes years, even decades, to build wealth in the stock market. Younger investors need to understand that and be willing to be patient. Another lesson that younger investors can teach older ones is the importance of diversification. Just because you've been burned by crypto in the past doesn't mean you should diversify your portfolio across different asset classes, including crypto. Don't let your age or past experiences dictate your investment strategy. Be willing to explore different options and invest in what makes sense for you. Of course, that doesn't mean you should go all in on crypto like some younger investors are doing. In fact, most financial advisors recommend that investors of all ages limit their exposure to crypto to no more than 10% of their portfolio. That is because crypto is still a very volatile asset class, and there is no guarantee that it will continue to grow in value. But even if you don't want to put a lot of money into crypto, it's still worth understanding the technology and how it works. Crypto is not going away, and it is likely that it will play a bigger role in the future of finance. So the more you understand about it, the better positioned you'll be to take advantage of any opportunities that come your way. Another thing that younger investors are doing that older ones can learn from is using technology to their advantage. There are a ton of great investment apps out there that make it easy to buy and sell stocks, ETFs, and crypto. These apps often have lower fees than traditional brokerage firms, and they provide a user-friendly interface that's perfect for beginners. In addition, these apps typically offer a wide range of educational resources that can help you learn about investing. So if you're a beginner, don't be afraid to use these tools to your advantage. Of course, it is important to remember that investing is a personal journey, and what works for one person may not work for another. If you're an older investor, don't feel like you have to invest in crypto just because it's popular with younger people. And if you're a younger investor, don't feel like you have to go all in on crypto just because it's trendy. Take the time to develop an investment strategy that aligns with your goals, risk tolerance, and comfort level. You can also benefit from getting advice from a financial advisor. A good financial advisor can help you develop an investment plan that takes into account all of your unique circumstances. They can also provide guidance and support as you navigate the sometimes choppy waters of the stock market. So if you're struggling to get started or feel like you're not on the right track, consider speaking with a financial advisor. Finally, no matter what your age, it's important to keep learning and stay informed about the markets. The world of finance is constantly changing, and you need to be willing to adapt. Read books, attend seminars, and follow industry experts to stay up to date on the latest trends and developments. The more you learn about investing, the better positioned you'll be to make smart decisions and achieve your financial goals. So what can you learn from younger investors? Well, first, they're often more confident in their ability to manage their finances, and they're really not afraid. 2. Experiment with new investment strategies. Second, they're comfortable using technology to their advantage, and they're willing to embrace new financial technologies like crypto. Finally, they understand the importance of long-term thinking, and they're willing to be patient with their investments. By learning from younger investors, you can develop a more well-rounded investment approach that takes advantage of the best of both worlds. Remember, it's not about being young or old, it's about being smart. So whether you're a seasoned investor or just getting started, always strive to learn and improve. After all, the markets don't care how old you are. They only care about one thing: whether or not you're a smart, educated investor. Thanks for watching. We hope you enjoyed this video and learned something new. If you did, please give us a like and subscribe so you never miss an update. Thanks for watching.